Let's get across the market open. Kyle Rodder joining us from Capital.com. Kyle, welcome to Thursday. Good to have you back on the show. Let's start stateside, of course. The US government shutdown in effect. Also getting some jobs numbers. What have you seen?
Yeah, I mean, the shutdown caused some initial jitters, perhaps at the open, really knee-jerk kind of stuff. But I mean, historically, markets have kind of moved through this and looked through these sort of political disruptions. So ended higher by the end of the day, and we'll sort of obviously wait now for to what extent this interrupts the data flow, as well as maybe leads to some permanent layoffs if the Trump administration potentially gets its way. But really the critical detail last night was that ADP payrolls report. It was worse than expected. Saw a fairly significant loss in jobs of about 32,000 from memory, and even downward revision on the month prior as well. And although there isn't a great deal of predictive value in the ADP figures of the upcoming non-farm payrolls release, which of course we may not even get this week, if you do look at the ADP figures compared to where payrolls are post revisions, it actually has some predictive value and suggests that maybe it's a more timely indicator of labour market strength. So as a result, we're getting pretty clear signals that the labour market is deteriorating in the United States. The markets responded not so much by selling equities off the back of that. In fact, obviously didn't really sell. There wasn't much selling going on by the end of trade at all on Wall Street. But we did see that the markets are now fully pricing in an October cut. It was about 90% implied probabilities prior to that data, and December is now considered about a 90% chance of a cut as well, with the federal funds rate looking at a trough rate next year of 2.9%, so sub 3%. So fairly significant. Didn't rock the boat in terms of stocks, but certainly it's increasing these probabilities of rate cuts from the Fed. And now we'll wait for that official data whenever we happen to get it in terms of the non-farm figures.
Yeah, until that point, Carl, just on the fact that we're not going to get the payrolls numbers at the end of the week, how do you think investors are likely to move on that? Is it going to prompt a little more caution, do you think?
I think what could happen is, depending on how long this shutdown lasts, is just increase a little bit of uncertainty in the markets, because we're going to have a little bit less data than we would otherwise have, and that could increase volatility at the margins. I think overall, the direction of travel for the US labour market is reasonably clear. Even over the last few months, the markets have looked less on the official jobs figures, one, because they're considered less reliable, and that's kind of a fairly mechanical issue with how the data is being collected and low response rates and the revisions that subsequently, as we've seen, come through and sort of tell us that we can't take the numbers when we get them month on month at face value. And then there's also obviously the concerns about how politicized the BLS has become, and investors looking for other ways to try and get information about the labour market to sort of determine the path forward for US monetary policy and obviously the US economy. So again, it could create a little bit of additional volatility at the margins, because there is a little less information and therefore a little more uncertainty. But for the most part, I think the markets are pretty clear on the position that the labour market needs some support, that obviously that's going to require further rate cuts coming down the line. And really that's quite a high conviction position for market participants right now.
Kyle, that uncertainty is continuing to lend support to gold. How are you seeing that trade at the moment?
Yeah, I mean, it's a really, really hot trade, and predominantly we've seen the breakout in gold recently because of these expectations of deeper interest rate cuts from the US Federal Reserve, and that's obviously manifested at different stages in lower yields, especially at the front end, but in particular some softness in the US dollar. But there's a multitude of factors driving gold higher. Obviously the shutdown has been a narrative that the markets have bought into. Yesterday, when we did see that announcement of a shutdown, or the sort of clock expire on a funding bill there, that gold prices did push higher a little bit. There is ultimately, though, this whole sense that, the structural factors behind gold are very strong. There is that kind of at the margins de-dollarization story, which is sort of driving a lot of central banks to hold higher allocations to gold rather than, say, the US dollar. There's the US economy slowing down and interest rate cuts. There's institutional issues there and a loss of institutional trust, not just in the Fed, but other, institutions in the United States as well. And then we can't forget, too, there is this overall sense that perhaps fiscal sustainability is a little bit precarious in the United States and across the world as well. And there's been a sort of a broad-based push into gold, more than just obviously those who don't want to hold US dollars, holding fair currencies, more generally speaking. So you could say sentiment's getting very, very hot. I mean, the RSI, if you look at it from just a technical perspective, is at about 80 on the daily RSI, which is typical of a market that is very, very overbought. All these things that you could sort of lay against gold at the moment to suggest that there really needs to be a pullback, but the fundamentals are so extraordinarily strong. And again, once more, if we continue to see both political instability in the short term in the States, as well as clear signs of deterioration in economic fundamentals, it's hard to be a seller in gold with those as your fundamentals.
Is there an expectation the US dollar is going to continue to come under pressure, and if so, what are you seeing, particularly with the Aussie? And it also comes down to the path of for interest rates. Perhaps where we're likely to see the Aussie rate sitting comfortably above what we've seen in the US.
Yeah, it depends on the nature of the slowdown in the United States. I definitely think, and as we saw last night, some of the G4 pairs were outperforming against the US dollar, in particular the Japanese yen, which itself is also kind of confronting some different fundamentals in terms of Japan. That's just because it's likely that we'll start to see some further interest rate hikes coming through the Japanese economy. But if we see sort of a moderate slowdown in the United States that sort of avoids a recession, that would be positive, say, for the Australian dollar, because we wouldn't get that kind of depressing effect of a weaker and recessionary US economy on the rest of the world, which would hit obviously a high growth currency like the Australian dollar. So if we get that coupled with obviously monetary policy in Australia that might be fairly steady for the next 6 or 7 months as the US Federal Reserve cuts rates, that could conceivably push the Aussie dollar higher as well. But if we do see the US economy sort of falling off the precipice a little bit, maybe the shutdown contributes to that. If we do see some permanent layoffs and the second and third order impacts that may have on US economic activity, then conceivably the Aussie dollar will sort of be dragged down because the whole global economy will start to soften, and there'll be that sort of risk off play. So it really depends on the nature, almost like everything at the moment. Equities is the same dynamic. It depends on the nature of the slowdown of the US economy, to what extent the Fed can ease to stay ahead of that and make sure that it is really just a modest slowdown in growth rather than an outright contraction. But for the time being and over the next few days, my sense is, again, while risk appetite is still there, the Aussie has the capacity to keep drifting through sort of 66, the 66 handle, and really the key level is a little bit above 67 at the moment, which if we sort of break through, suggests there is maybe another sort of technical buying pressure that could come through the pair.